You know what's fascinating about market manipulation? It's not that it happens. Everyone knows it happens. What's fascinating is watching it unravel in real time while the mainstream media is completely silent about it. And right now, we're watching something extraordinary unfold in the silver market that has all the hallmarks of 2021's silver squeeze. Except this time, it's bigger, it's quieter, and the people orchestrating it have learned from their mistakes. Let me paint you a picture of what's happening right now. 3 weeks ago, a group of hedge funds quietly started accumulating physical silver through a network of dealers most people have never heard of. Not COMEX contracts, not SLV shares, physical metal, bars, coins, the real stuff. And they're doing it in a way that's deliberately flying under the radar because they learned something crucial from the GameStop and silver squeeze of 2021. If you telegraph your moves, the big banks will crush you before you can execute. Here's where it gets interesting. The COMEX silver inventory has dropped by 47 million ounces in the last 6 weeks. That's not normal seasonal variation. That's not industrial demand. That's a coordinated withdrawal of physical metal from the exchange, and it's happening at the exact same time that open interest in silver futures is climbing to levels we haven't seen since the 2011 peak. Someone is setting up for a massive delivery squeeze, and they're doing it so quietly that most analysts are completely missing it. Now, I want you to understand something about how the silver market actually works, because this is where the whole house of cards becomes visible. The COMEX operates on something called fractional reserve. For every ounce of physical silver in their vaults, they've issued claims on roughly 100 ounces through paper contracts. It's the same game the banks play with your deposits, except with precious metals. And it works perfectly fine, as long as nobody actually asks for delivery. The moment people start standing for delivery in size, the whole system seizes up like an engine without oil. And that's exactly what's starting to happen. In October, delivery notices on the COMEX hit 8,200 contracts. That's 41 million ounces. In a normal month, you might see 2,000 contracts stand for delivery. We're seeing 4 times that, and November is tracking even higher. The people who understand the mechanics of this market are watching these numbers and quietly backing up the truck because they know what comes next. Let me tell you a story about what happened in 1980 that almost nobody remembers correctly. Everyone knows the Hunt brothers tried to corner the silver market, and it ended badly for them. What people don't know is that they actually succeeded for a brief moment. Silver went from $6 to $50 in less than a year, and it wasn't because of speculation. It was because they figured out the same thing these hedge funds have figured out now. If you take delivery of physical metal, you expose the paper game. The Hunt brothers' mistake wasn't the strategy. Their mistake was doing it openly, giving the exchanges time to change the rules mid-game. They literally changed margin requirements and position limits specifically to crush the Hunts. It was blatant market manipulation to stop market manipulation, and it worked. But here's what's different this time. The people orchestrating this current squeeze aren't doing it from one family office in Texas. They're doing it through a distributed network of funds, family offices, and high-net-worth individuals, who are all independently coming to the same conclusion. Silver is the most undervalued hard asset on the planet, and the paper market is vulnerable. You can't change the rules to stop 1,000 different players who aren't coordinating. You can't raise margin requirements high enough to shake out people who are taking physical delivery and walking away. And the fundamentals supporting this move are absolutely staggering. Global silver mine production peaked in 2016 at 900 million ounces and has been declining ever since. We're now at around 830 million ounces annually. Meanwhile, industrial demand has exploded. Solar panels alone are consuming 140 million ounces a year, and that number is projected to hit 185 million by 2027. Electric vehicles use twice as much silver as traditional cars. 5G infrastructure is silver-intensive. We're in the middle of an industrial revolution that runs on silver, and we're producing less of it every year. But here's the kicker that nobody's talking about. Investment demand has been dead for 3 years. After the 2021 squeeze fizzled, retail investors got burned and walked away. Silver ETF holdings have been declining. Coin sales dropped. The investment community gave up on silver, and that created this perfect setup where industrial users are consuming more, production is declining, and there's no investment buffer. The market is tight as a drum, and these hedge funds know it. I'm looking at data from the Silver Institute right now, and the numbers are genuinely shocking. We're running a structural deficit of 142 million ounces this year. That means the world is consuming 142 million more ounces than we're producing. Where's that silver coming from? It's coming from above-ground stockpiles. It's coming from COMEX inventories. It's coming from ETF redemptions. And those sources are finite. At the current rate of drawdown, we're looking at critically low inventories within 18 months. Maybe less, if investment demand comes back. And here's where your retirement security intersects with all of this. Because while these hedge funds are positioning for a price explosion in silver, there's a parallel move happening in gold that's even more significant for long-term wealth preservation. Central banks bought 1,037 tons of gold in 2023. They're on track to buy even more this year. That's not speculation. That's the people who control monetary policy voting with their reserves about where they think value is going to be preserved. Quick aside here, because this is relevant if you're sitting on $100,000 or more in retirement accounts. I put together a comprehensive guide on how gold IRAs actually work. It's in the description below. Covers the mechanics of getting physical gold into your retirement account without triggering tax penalties, which custodians actually hold the metal versus just paper claims, and how the whole process works from start to finish. Worth checking out if you're thinking about diversifying out of traditional assets. No pressure, just there if it's useful for your situation. Anyway, back to what's happening in silver right now, because the technical setup is absolutely textbook. We've got a massive cup and handle formation on the monthly chart that's been building for 3 years. The handle just completed last month, and we're breaking out right now. The target on that pattern, if it plays out, is $47. That's not some wild speculation. That's just basic technical analysis based on the depth of the cup and the measured move. And that's before any squeeze dynamics kick in. But let's talk about what a real squeeze would look like, because I think most people don't understand the mechanics. In 2021, silver went from $24 to $30 in a matter of days when retail investors piled in. That was a 25% move, and it happened with zero actual supply disruption. It was pure paper market dynamics and some modest physical buying. Imagine what happens when you have actual delivery failures on the COMEX. When funds are standing for delivery and the exchange can't source the metal. When industrial users start panicking about supply and begin hoarding. That's not a 25% move. That's a repricing event. And there are signs this is already starting. Premiums on physical silver have been climbing steadily for 6 weeks. American Silver Eagles are trading at $4 over spot. That's a 13% premium on a 1-ounce coin. Dealers are reporting delays on large orders. Refineries are running at capacity. These are the early warning signs of a physical market that's tightening, and most investors have no idea it's happening because they're watching the paper price on their screens and thinking everything is fine. Let me give you some context on why this matters beyond just the silver market. We're living through the largest monetary experiment in human history. Since 2020, global central banks have created more currency than existed in all of human history prior to 2020. Think about that. More dollars, euros, yen, and yuan have been created in the last 5 years than in all of recorded civilization before that. And that money is sloshing around the system looking for hard assets to hide in. Real estate is overvalued by every historical metric. Stocks are trading at valuations that only made sense during the dot-com bubble. Bonds are offering negative real yields after inflation. Where does smart money go when everything is overvalued? It goes to the assets that are undervalued relative to the money supply. And by that measure, silver is the most undervalued asset on the planet. The gold-to-silver ratio is sitting at 84-1 right now. The historical average is 60-1. The natural occurrence in the Earth's crust is 17-1. We're mining it at about 8-1, and it's trading at 84-1. That's not a market. That's a distortion waiting to correct. And here's what nobody's connecting. China has been quietly accumulating silver for 2 years through state-owned enterprises. Not through official reserves where they have to report it. Through industrial companies and strategic stockpiles that don't show up in the data. We know this because Chinese imports of silver have been running 40% above their industrial consumption. Where's that extra silver going? It's going into vaults. It's being stockpiled. And China doesn't stockpile commodities unless they expect either supply disruptions or price appreciation? Usually both. The geopolitical angle here is crucial. We're watching the de-dollarization trade play out in real time. The BRICS nations are building alternative payment systems. They're settling trade in local currencies. They're accumulating gold and silver as reserve assets outside the dollar system. This isn't conspiracy theory. This is official policy from countries representing 45% of global GDP. And when you're building a new monetary system, you need hard assets to back it. You need gold and silver. Russia announced last month they're linking the ruble to gold and a basket of commodities. Saudi Arabia is accepting yuan for oil sales. The UAE is building a gold-backed digital currency. These are seismic shifts in the global monetary architecture, and they all point to the same conclusion. The era of pure fiat currency backed by nothing but government promises is ending. We're moving back toward commodity-backed money, and the countries that accumulate gold and silver now are going to have enormous leverage in whatever system emerges. Now let me show you something that should terrify anyone who understands market structure. The 8 largest short positions in silver futures are held by just 3 banks. 3 institutions control the short side of the silver market to a degree that would be illegal in any other commodity. The concentration ratio is off the charts, and these aren't hedged positions. These are naked shorts. Bets that silver will go down, backed by nothing but the ability to print more paper contracts. It's the same game that blew up Lehman Brothers, except this time it's in the commodity markets. And here's why that matters for the squeeze thesis. When you have that level of concentration, you create systemic risk. If silver starts moving against these shorts, they can't all exit at once. The market isn't liquid enough. They'd be buying from each other and driving the price vertical. It's the same dynamic that caused the nickel squeeze on the London Metal Exchange in 2022, when prices went from $30,000 to $100,000 in 2 days, and they had to halt trading. Except the silver market is bigger, more important, and more politically sensitive. The people setting up this squeeze understand something crucial. The banks can manipulate the paper price, but they can't create physical metal. And once the physical market disconnects from the paper market, once premiums blow out and delivery failures start happening, the game is over. The paper price becomes irrelevant because nobody will sell physical metal at the paper price. We saw this briefly in 2020 when silver hit $12 on the COMEX, but you couldn't buy physical silver for less than $20. That spread was the market screaming that the paper price was fake. And we're starting to see that dynamic again. Spot price is $25, but try to buy 1,000 ounces of physical silver right now. You're paying $26.50 minimum, probably $27 if you want it this month. That's a 10% premium, and it's widening. That's the physical market telling you the paper price is wrong. And when that spread gets wide enough, arbitrage players will start standing for delivery on COMEX contracts, taking the metal and selling it in the physical market for the premium. That's when the exchange runs out of metal. That's when the squeeze goes exponential. Let me tell you what happened in March 2020 that almost broke the silver market. When COVID hit and everything shut down, the refineries that turn 1,000-ounce bars into smaller retail products stopped operating. Suddenly you had this bizarre situation where there was plenty of silver in COMEX vaults, but none of it could get to retail buyers because the supply chain was broken. Premiums on retail silver went to 100% over spot. People were paying $35 for silver that was trading at $15 on the COMEX. And the banks that were short couldn't deliver into that demand because their silver was in the wrong form. That was a supply chain squeeze. What's being set up now is a delivery squeeze. It's more fundamental and more dangerous for the shorts. Because this time, the metal is leaving the COMEX entirely. It's going into private vaults. It's going to India. It's going to China. It's going into solar panels and electric vehicles where it's consumed and gone forever. The banks can't get it back. And every ounce that leaves the system makes the remaining ounces more valuable and the paper claims more precarious. I want you to think about the psychology of what's happening here. For 3 years, silver investors have been beaten down. They've watched gold make new all-time highs while silver languished. They've been mocked by mainstream analysts who say silver is just an industrial metal with no monetary value. They've been told the squeeze is over, retail lost, move on. And that demoralization created the exact conditions for a real squeeze to develop. Because nobody's watching. Nobody's positioned. and the smart money is accumulating in size while everyone else is looking the other way. This is how major market moves happen. They don't happen when everyone's excited and positioned. They happen when everyone's given up. The best trades are the ones that feel wrong, that go against the consensus, that make you uncomfortable. And right now, being long silver feels wrong to most people. It feels like you're fighting the Fed, fighting the banks, fighting the trend. But that's exactly why it's probably right. The Fed is trapped. They can't raise rates high enough to truly fight inflation without breaking the economy. They can't lower rates without reigniting inflation. They're stuck in this impossible position where every move makes something worse. And in that environment, hard assets win. Gold wins. Silver wins. Real things with real utility win. Paper promises lose. And silver has this unique characteristic where it's both a monetary metal and an industrial metal. It benefits from monetary debasement like gold, but it also benefits from industrial demand growth. It's the only metal that sits at the intersection of the inflation trade and the green energy trade. Solar panels need silver. Electric vehicles need silver. 5G needs silver. The entire technological infrastructure of the future runs on silver, and we're not producing enough of it. The deficit I mentioned earlier, that 142 million ounces, that's not a one-year problem. That's structural. Mine production is declining because the easy deposits have been mined. The ore grades are falling. It takes longer and costs more to bring new supply online. And most silver is produced as a byproduct of copper, lead, and zinc mining. So silver supply is dependent on the economics of other metals. You can't just decide to produce more silver. It doesn't work that way. Meanwhile, solar panel installations are growing at 20% annually. Electric vehicle production is growing at 30% annually. These are exponential growth curves running into a declining supply curve. That's not a recipe for stable prices. That's a recipe for a supply crisis. And the market hasn't priced this in yet, because the paper market is still in control. But that control is slipping. I'm watching the commitment of traders report every week, and the positioning is absolutely fascinating. Commercial hedgers, the big banks, are at their lowest net short position in 5 years. That means they're covering shorts. They're reducing their exposure. And they're doing it quietly, in small increments, trying not to move the market. But you can see it in the data. They know something is coming. They're getting out of the way. At the same time, large speculators, the hedge funds, are building long positions. Not huge positions yet, not enough to trigger alarm bells, but steady accumulation, week after week, building a position for a move they think is coming. And the small speculators, retail traders, are still net short. Retail is still betting against silver. That's the perfect setup. When retail is wrong and commercial hedgers are covering, that's when big moves happen. Let me give you a specific example of how fast this can move. In September 2010, silver was trading at $18. By April 2011, it hit $49. That's a 172% move in 7 months. And that wasn't even a real squeeze. That was just momentum and some modest physical buying. The COMEX never came close to running out of metal. Imagine what happens when there's an actual delivery crisis, when industrial users are competing with investors for limited supply, when the exchange is scrambling to source metal. That's not 172% in 7 months. That's 172% in 7 weeks. And here's what makes this setup even more explosive. The options market is completely unprepared for a big move. Open interest in out-of-the-money call options is minimal. Nobody's positioned for silver to go to $40 or $50, which means if it starts moving, there's no options hedging to slow it down. It's just pure directional momentum with no speed bumps. The gamma squeeze potential is enormous. For those who don't know options mechanics, here's what that means. When people buy call options, the dealers who sell those options have to hedge by buying the underlying asset. The closer the price gets to the strike price, the more they have to buy. It creates a feedback loop where rising prices force more buying, which causes more rising prices. It's what happened with GameStop. It's what happened with AMC. And the silver market is set up for the exact same dynamic, except with a commodity that has actual supply constraints. The people orchestrating this understand all of this. They're not buying silver because they think it's going to go up 10%. They're buying silver because they think the paper market is going to break, and the price is going to gap to levels that seem absurd right now. They're positioning for $60, $80, maybe $100 silver. Not in 10 years. In the next 18 months. And they're willing to take delivery and hold physical metal because they don't trust the paper system to survive what's coming. Now, I want to be clear about something. I'm not telling you silver is going to $100 next month. Markets don't move in straight lines. There will be pullbacks. There will be volatility. The banks will fight this. They'll slam the paper price. They'll try to shake out weak hands. But the underlying fundamentals are so strong, and the physical market is so tight, that every pullback is just another accumulation opportunity for people who understand what's happening. And this isn't just about making money on a trade. This is about understanding the transition we're living through. We're watching the end of the post-1971 monetary system. We're watching the end of pure fiat currency. We're watching the return of commodity-backed money. And the people who position for that transition early, who accumulate hard assets before the crowd figures it out, are going to preserve and grow wealth in ways that seem impossible to people who stay in traditional assets. The silver squeeze that's starting right now is just one symptom of a much larger shift. It's a symptom of a system that's breaking down. A symptom of money printing that's gone too far. A symptom of paper claims that exceed physical reality by orders of magnitude. And when systems break down, they don't do it slowly and predictably. They do it suddenly and violently. One day everything seems fine, and the next day the rules have changed and the game is over. That's what happened in 1971, when Nixon closed the gold window. That's what happened in 2008 when Lehman collapsed. That's what happened in 2020, when the entire economy shut down. These phase transitions happen fast, and the people who see them coming and position accordingly are the ones who survive and thrive. Everyone else is left wondering what happened. So when I tell you the Silver Squeeze 2.0 has started and nobody noticed, I'm not being hyperbolic. I'm watching the data. I'm watching the inventory drawdowns. I'm watching the delivery notices. I'm watching the premiums. I'm watching the positioning. And all of it is pointing to the same conclusion. Something big is coming in the silver market, and most people are going to miss it until it's too late. The question isn't whether this is happening. The question is whether you're going to position for it before the crowd figures it out, or whether you're going to wait until silver is at $40 and everyone's talking about it, and the easy money has already been made. Because that's how these moves work. The real money is made by the people who see it coming and act while everyone else is still skeptical. By the time the mainstream media is covering it, by the time your neighbor is talking about it, the move is mostly over. And here's the final piece that ties this all together. The silver market is tiny. Total above-ground silver inventory is worth maybe $50 billion. That's less than the market cap of many individual stocks. It's a rounding error in the global financial system, which means it doesn't take much capital to move it. A few $1 billion of real buying, actual physical demand, and the price can move dramatically. And when you consider that there are hedge funds with $10 billion, $20 billion under management who are starting to look at silver, the math gets really interesting, really fast. This is the setup. This is the opportunity. This is the moment before the crowd arrives. The Silver Squeeze 2.0 has started. The smart money is accumulating. The physical market is tightening. The paper market is vulnerable. And most people have no idea it's happening. The question is, what are you going to do with that information?